Hello everyone, and welcome to Accounting 2020. My name is Jim Forbes, instructor. Let's start with a couple suggestions with this chapter as well as the other chapters coming. First of all, Chapter 14, in my opinion, most students feel like this is by far the hardest chapter. And it is a heavy for many reasons, not only from accounting, but you'll see this chapter again in or similar discussion items in finance and so forth, because it talks about bonds, long-term liability. And the bond market is far bigger than the stock market. In fact, it makes the stock market look like petty cash. The bond market is actually central to capitalism and global finance around the world. So it's a very, very important thing to start understanding about bonds. However, just because it's big does not mean it's easy. It's actually quite complex. There's a lot of variation and depth to this subject. So some suggestions for studying this chapter as well as some other chapters. A, be careful in your reading. Read slow and very carefully. It's highly detailed. I would also suggest starting your homework by starting with reading the book once, maybe try to learn smart. Now the learn smart grades you on completion, not on accuracy. And it's an algorithm that will focus you on areas that you are struggling in. And so it's not questions that I choose. It's strictly driven by the computer. After you've discovered the areas that you're struggling with, I'd go back to the book and reread and study very thoroughly those areas. And then I would go back and maybe take the practice exam. The practice exam is not for a grade. Again, it'll highlight how you think you're doing. And then you might go back to those areas again where you're struggling. And then do the homework last. Because the homework is part of your grade. And in the homework you get 2 attempts. With the first attempt at 100% and the second attempt is at 50%. So you want to try to be very good on your homework, whereas the other ones is more based on completion. And I think that will help you quite a bit, as well as all the other chapters, but especially with this chapter. And do not wait. Most students like to see that the homework is due maybe on Sunday night, maybe even start studying on Sunday evening. Not with accounting. And the reason for accounting, as you know from Accounting 1, is that it's not just concept and theory and vocabulary, it's also application. And that application gives it its detail and its complexity. So again, give yourself time. Okay, let's get into the bond market and long-term liabilities. Bond financing. The advantages for the company and the big one is that the bonds do not affect owner control. So it doesn't affect the board of director choices, voting control of the stock, or anything like that. The second advantage is that the interest on the bonds is tax deductible, whereas in dividends on stock is not. But interest on bonds is tax deductible, so it helps you on your income statement. And bonds can increase return on equity. This is a concept you'll study in finance, and it's called financial leverage. By borrowing money, if you can earn a rate of return that's higher than your interest, you'll increase the return on your equity of your stock. Hence, a lot of companies borrow for that very reason. The board of directors demand it. And it is prudent. So a lot of people say, oh, I never want to borrow money. That's not a good philosophy, actually. You should borrow when you can make more than the cost of funds with the management of risk. So it's not just quantitative. There also has to be some qualitative aspects to this. However, in bond financing, nothing's perfect. There are also disadvantages. And the disadvantage to the company is that bonds require a payment of interest, typically on long-term bonds. It's every 6 months. And then you have to pay off the loan when that bond becomes mature. So you have to make these interest payments, whereas dividends is not mandatory. Dividends are only required when the board of directors decides there's enough capital to pay dividends or enough profits. That's not true with bonds. The bondholder can actually take a company into bankruptcy, whereas a stockholder cannot. So there are some legal advantages, and it's also priority of return. Bondholders will get paid before the stockholders. So, And then again, the second thing is bonds can decrease return on equity. And how that works, if you're losing money or you're not making as much money as the cost of your money, then that leverage now works against you and magnifies your losses. Bonds are actively traded in the world market. Again, this is a huge market. In fact, let me give you an example of one market here right now. Here is a chart of the, let me blow this up. This is the bond market, or bond futures, traded on the September bond, on the what's called the long bond, or the 30-year bond. And as you can see, this is, I think, a 5-year rate, a 5-year chart showing that these bonds go up and down in value. Again, they're actively traded. I used to be a fairly active but small bond trader. I managed an investment fund, and whereas I'd move maybe $10–20 million at one keystroke, I have literally seen billion-dollar transactions go down in virtually a second or two. Huge magnitude of money that moves in the bond market makes the stock market look like very, very small. Now I can take this down to 25 a year, 1 year. You can see this down. Let's just see what it did today. It dropped. It had a pretty big day. The stock market went up, and bonds dropped here. And so you can see where bonds ended up at 59, but this was just in today's trading. So you can see during the intraday, there's a lot of activity here, and then it moved up. There's a lot of money moving around here. So again, this is a very, very actively traded instrument. So again, you're going to see this in finance coming forward. So it's worth noting on that. Let me get out of this. Why is it not? Why am I not getting out? So here's a couple things that might show up on a bond trader's screen when he's looking to buy or sell his bonds. You'll see maybe the company here, it happens to be IBM. This is the coupon, or what is known as the contract rate. It's paying 5.7% at 17 years to maturity. It's yielding 4.7. Notice the difference between the yield and the rate. And that difference is caused by price. That price can change. This is how many bonds have traded for the day, and this is the actual price. And then that's the change in value and a percentage. Let me get it to you. Let me see. Notice that the price, now bonds trade in $1,000 increments. And so this price is 121. That's in percentage. So it's 121%. So to get the actual price, you add 10 or move this decimal point over. So this bond was buying, the buyer is paying $1,211.80, hence a premium of over $200. That is what affects this yield going down from the rate. It can go the other way too. If you pay less than the par value, and then it would increase your yield over the coupon rate. We'll get into this a little bit more. Here is in the old days, they actually gave you a bond certificate. Now most are just simply held in an account and registered in your name. But it would list the name of the company, how much the bonds are for. Again, they trade in $1,000 increments. This person owns $10,000. Here's the owner. It could be a QSIP number. That's the registration, securities registration. Here's your due date. And this is the coupon and contract rate. So all this is now done electronically. But it has been in the old days in the physical format. Okay, I'm going to stop here and we'll start a next video because I want to keep these under about